And it's only with reform that we can avoid a similar outcome in the future. In other words, a vote for reform is a vote to put a stop to taxpayer-funded bailouts. That's the truth. End of story. And nobody should be fooled in this debate. By the way, these changes have the added benefit of creating incentives within the industry to ensure that no one company can ever threaten to bring down the whole economy. To that end, the bill would also enact what's known as the Volcker Rule. And there's a tall guy sitting in the front row here, Paul Volcker, who we named it after. And it does something very simple. It places some limits on the size of banks and the kinds of risks that banking institutions can take. And this will not only safeguard our system against crises, this will also make our system stronger and more competitive by instilling confidence here at home and across the globe. Markets depend on that confidence. Part of what led to the turmoil of the past 2 years was that in the absence of clear rules and sound practices, people didn't trust that our system was one in which it was safe to invest or lend. And as we've seen, that harms all of us. So by enacting these reforms, we'll help ensure that our financial system and our economy continues to be the envy of the world. So that's the first thing, making sure that we can wind down one firm if it gets into trouble without bringing the whole system down or forcing taxpayers to fund a bailout. Number two, reform would bring new transparency to many financial markets. As you know, part of what led to this crisis was firms like AIG and others who were making huge and risky bets using derivatives and other complicated financial instruments in ways that defied accountability or even common sense. In fact, many practices were so opaque, so confusing, so complex that the people inside the firms didn't understand them, much less those who were charged with overseeing them. They weren't fully aware of the massive bets that were being placed. That's what led Warren Buffett to describe derivatives that were bought and sold with little oversight as financial weapons of mass destruction. That's what he called them. And that's why reform will rein in excess and help ensure that these kinds of transactions take place in the light of day. Now, there's been a great deal of concern about these changes, so I want to reiterate. There is a legitimate role for these financial instruments in our economy. They can help allay risk and spur investment. And there are a lot of companies that use these instruments to that legitimate end. They are managing exposure to fluctuating prices or currencies, fluctuating markets. For example, a business might hedge against rising oil prices by buying a financial product to secure stable fuel costs. So an airlines might have an interest in locking in a decent price. That's how markets are supposed to work. The problem is these markets operated in the shadows of our economy, invisible to regulators, invisible to the public. So reckless practices were rampant, risks accrued until they threatened our entire financial system. And that's why these reforms are designed to respect legitimate activities but prevent reckless risk-taking. That's why we want to ensure that financial products like standardized derivatives are traded out in the open, in the full view of businesses, investors, and those charged with oversight. And I was encouraged to see a Republican senator join with Democrats this week in moving forward on this issue. That's a good sign. That's a good sign. For without action, we'll continue to see what amounts to highly leveraged, loosely monitored gambling in our financial system, putting taxpayers and the economy in jeopardy. And the only people who ought to fear the kind of oversight and transparency that we're proposing are those whose conduct will fail this scrutiny. Third, this plan would enact the strongest consumer financial protections ever. And that's absolutely necessary because this financial crisis wasn't just the result of decisions made in the executive suites on Wall Street. It was also the result of decisions made across kitchen tables across America by folks who took on mortgages and credit cards and auto loans. And while it's true that many Americans took on financial obligations that they knew or should have known they could not have afforded, millions of others were, frankly, duped. They were misled by deceptive terms and conditions buried deep in the fine print. And while a few companies made out like bandits by exploiting their customers, our entire economy was made more vulnerable. Millions of people have now lost their homes. Tens of millions more have lost value in their homes. Just about every sector of our economy has felt the pain, whether you're paving driveways in Arizona or selling houses in Ohio, or you're doing home repairs in California, or you're using your home equity to start a small business in Florida. That's why we need to give consumers more protection and more power in our financial system. This is not about stifling competition, stifling innovation. It's just the opposite. With a dedicated agency setting ground rules and looking out for ordinary people in our financial system, we will empower consumers with clear and concise information when they're making financial decisions. So instead of competing to offer confusing products, companies will compete the old-fashioned way by offering better products. And that will mean more choices for consumers, more opportunities for businesses, and more stability in our financial system. And unless your business model depends on bilking people, there's little to fear from these new rules. So, number 4, last key component of reform. These Wall Street reforms will give shareholders new power in the financial system. They will get what we call a say on pay, a voice with respect to the salaries and bonuses awarded to top executives. And the SEC will have the authority to give shareholders more say in corporate elections, so that investors and pension holders have a stronger role in determining who manages the company in which they've placed their savings. Now, Americans don't begrudge anybody for success when that success is earned. But when we read in the past, and sometimes in the present, about enormous executive bonuses at firms, even as they're relying on assistance from taxpayers, or they're taking huge risks that threaten the system as a whole, or their company's doing badly, it offends our fundamental values. Not only that, some of the salaries and bonuses that we've seen create perverse incentives to take reckless risks that contributed to the crisis.